Let's move on now and look a little bit at what IBM's clients are actually doing in response to these issues. So presumably you're in a constant dialogue with your clients. What do you see them doing at the moment in terms of their sort of internal changes?
I mean, first and foremost, they're taking an enterprise view of risk, and it's true, but it's probably a consequence of that situation that innovation has been too fast and too strong. Mm-hmm. That risk, not just risk management, but most of business management systems have developed in silos. And actually, this is where probably the banks are very good. It's within the domain of a particular business or particular business line. I think they do an excellent job in managing risk and valuation and reporting. Where it gets complicated, it's when it comes to bring all these pieces together. Not just at the enterprise level, but as my colleague Keith was talking about at the industry level. So the big question today is how to evolve from these very good, very powerful systems that have been developed at the business line level to build something that is more or that serve the organization better. Not just in terms of avoiding disaster, and although probably is a primary function of risk management to avoid disaster, but also to ensure the proper balance of resource allocation and especially capital, and balance between short-term and long-term profitability and the consumption of resources. Mm-hmm. So when our clients come to us increasingly, they describe us, what they have achieved over the last few years, and we know, and because sometimes we have been participating in this development, how complicated and how expensive it is to have a good risk management system locally. So now the dialogue is, how can we transform the infrastructure, possibly gradually? So in some cases we will have to make step changes. Mm-hmm. But we are not going to rip and replace. It's too complicated. So how can we move from there to something that makes sense at the enterprise level and that is able to deliver coherent, quality information that can be used internally by the management and that can be disclosed, exposed outside to the regulators and to the public. Indeed, this is a huge challenge. This is a huge challenge because by nature, operating in many countries, having been through many acquisitions, mergers, having a business that are very different one from another, being subject to sometimes different regulation, different combination of relationship, it's very difficult to put everything in one basket and say, well, I'm going to produce that very clean report that everyone understands. But this is where we're heading to.
Mm-hmm. We talked earlier with Keith about supercomputing. Are there any other sort of actual new technologies out there that the firms are sort of looking to deploy, or is it sort of the same stuff but deployed in a different way?
Mostly, we're using technologies that were existing some years ago. They were not just applied because, again, the pace of development prevented to take the time sometimes to apply the best technology to a particular problem. Indeed, there are new technologies that allow us to do even more, to do almost real-time risk reporting. I'm not sure, not everyone is convinced that it is useful, but we can do lots of interesting things. We can, for instance, simulate complex portfolio in a matter of seconds of minutes in situation where it's almost impossible to do it if you have common static infrastructure. So processing powers have expanded, the network speed, storage capacity, and access speed have improved. There are lots of new technologies about doing better distributed computing. So that now we use the term cloud to just throw computing requirements somewhere on the network and get results. All that is exciting and probably will be used more and more in the future. But to address the very the deep problems of risk reporting, you don't need all that. It's probably better to do things faster. But the first thing you do is to have uniformity across your organization.
From the clients you speak to, bearing in mind the current climate, do they have any funding problems internally when it comes to building out their internal risk management infrastructures?
In all the projects we work, there is a business case. So it's actually part of our role to help our clients to build a business case. For instance, and increasingly, we try to generate value out of risk management. Because again, risk management is the neural system in the organization. So financial management is dealing with information. So when you have good information somewhere, there is added value you can derive from it. So you can do a better marketing. You can improve your pricing, the pricing of your products. And probably that was a big issue at the very start of the crisis, that some mortgages were not priced appropriately. So we can leverage risk information to do a better allocation of resources and especially capital. So we can manage the business and generate profitability reports that are based on a risk-adjusted mechanism. So there are tons of things that we derive from the same infrastructure, the same data, the same analytics that we use to control exposure, monitor and report solvency and liquidity, and do various other things. So this is how we build this business case.